Welcome back to Gold Rush Reporter. Today is not about hype. It is about reality, numbers, and preparation. If you are not mentally and financially ready, this market will shake you out. That is not an opinion. That is history repeating itself. We are living through a gold bull market that is unlike anything seen before. And silver is no longer quietly following. It is starting to behave differently, aggressively, uncomfortably, in a way that exposes weakness in the financial system. Rick Rule recently described the situation in blunt terms. More than $150 trillion in total obligations sitting inside a system that mathematically cannot support them. That number is larger than the combined private wealth of the entire United States. This is not politics, this is arithmetic, and arithmetic always wins. This is why silver does not simply rise slowly when currencies weaken. At certain moments, it detonates. Not 10%, not 20%. Historically, when confidence breaks, silver moves violently and quickly. That is what makes the current setup dangerous for people who are unprepared and powerful for those who understand it. In 2025 alone, silver surged over 130%, its strongest yearly performance since 1979. That is not normal market behavior. That is stress showing through the system. Markets do not move like this unless something underneath is breaking. And before you dismiss this as speculation, stop and think. This move is not driven by meme traders or short-term gamblers. It is driven by structural forces that are not going away. The first force is currency erosion. Official inflation numbers say one thing, but real life says another. Anyone paying rent, buying groceries, filling fuel, or running a business knows the truth. The real loss of purchasing power is closer to 8 to 9% per year, not what is shown on government charts. Now compare that to savings. The US 10-year Treasury yields around 4.2%. That means savers are losing purchasing power every single year. You are being paid less than the rate at which your money is being destroyed. That is not saving. That is slow liquidation. This is why precious metals matter. Not because of fear, because of math. When people finally understand that holding currency guarantees loss, behavior changes. Capital does not flow gradually. It flees. And when it flees, it does not go everywhere. It does not go into stocks when valuations are stretched. It does not go into crypto when volatility is extreme. It goes into what has no counterparty risk, physical metal. Silver, in particular, sits at the intersection of money and necessity. It is monetary insurance, but it is also essential to modern civilization. And that combination is rare. This is why the current move is not the end. It is the beginning of repricing. Silver is still far below its inflation-adjusted 1980 high. Gold has already reached new real highs. Silver has not. That gap matters. Historically, when silver starts to close that gap, it does not do it gently. And here is the uncomfortable truth most people do not want to hear. If you wait for confirmation, you will miss it. Silver never gives comfort at the right time. It gives clarity only after the move has already happened. Rick Rule put it plainly. When faith in money disappears, hesitation disappears with it. When that happens, silver does not climb. It explodes. That is the environment we are entering. Silver's recent surge is not happening in a vacuum, and this is where most people get it wrong. They look at the price chart and assume speculation is doing the heavy lifting. That assumption is lazy and inaccurate. What is happening in silver right now is being driven by structural demand colliding with structural supply limits, and that is a very different animal from a short-term rally. Let's start with demand, because this is where the story fundamentally changes. For decades, silver demand was cyclical. It rose and fell with the economy. That is no longer the case. Silver has quietly become a critical input for the modern world, and there is no substitute that can replace it at scale. Solar energy is the clearest example. High-efficiency solar panels require silver, not optional silver, required silver. Each panel uses roughly 15 to 25 grams, and global installations are hitting record highs year after year. By the end of this decade, solar alone is projected to consume hundreds of millions of ounces annually. And here's the key point. This demand does not go away if prices rise. Governments and utilities do not stop energy transitions because silver is more expensive. Electric vehicles tell the same story. EVs use significantly more silver than internal combustion cars. Power management systems, battery connections, charging infrastructure, all silver intensive. EV production is expected to multiply over the next several years, and that creates a steady, price-insensitive draw on supply. Now layer artificial intelligence on top of that. Data centers, high-performance computing, advanced electronics, all require silver for conductivity and heat resistance. As AI expands, so does silver demand. This is not speculation. This is infrastructure. When you add it all up, industrial demand alone is pushing toward levels that were unthinkable 20 years ago. And that demand is inelastic. It does not disappear in recessions. It does not pause during volatility. It keeps pulling metal out of the system. Now look at the supply side, and this is where things become uncomfortable. Silver production barely moves. Global mine supply increased only marginally in 2025, roughly 2%, reaching around 840 million ounces. That sounds large until you understand how silver is mined. The majority of silver does not come from primary silver mines. It is a byproduct of copper, lead, zinc, and gold mining. That means silver supply does not respond to silver prices. Even if silver doubles, miners cannot simply flip a switch and flood the market. Production decisions are driven by base metals economics, not silver. On top of that, ore grades are declining. Existing mines are aging. New projects face years of permitting delays, capital shortages, and environmental restrictions. Exploration was underfunded for more than a decade. That bill is now coming due. The result is persistent deficits. For the fifth consecutive year, silver demand is exceeding supply. Estimates suggest deficits ranging from 90 to 150 million ounces annually. Over the past 5 years, more than 800 million ounces have been drained from global inventories. That is not a paper problem. That is physical metal leaving vaults. Recycling is not saving the day either. It has plateaued. Scrap supply does not rise fast enough to offset demand growth, especially when industrial usage consumes silver permanently rather than storing it. This is why the current price action matters. The market is not reacting to headlines. It is reacting to scarcity. And now investors have noticed. When investors enter a market that is already structurally tight, price behavior changes. Small shifts in sentiment produce large moves. That is why silver does not move smoothly. It lurches. It overshoots. It scares people out and then leaves them behind. This is not a bubble forming. This is a repricing process. Silver is being forced to reflect its role in both monetary protection and industrial necessity. And this brings us to the next critical layer of the story. The gold-silver ratio, historical behavior during currency stress, and why silver historically accelerates after gold has already moved. Silver's relationship with gold is one of the most important factors for understanding where prices are headed next. Historically, silver acts as a high beta version of gold. That means it doesn't just follow gold, it amplifies gold's movements. When gold rallies, silver often accelerates beyond it. When gold pauses, silver temporarily lags, but eventually it catches up and then some. This is exactly the pattern we are seeing today. At the beginning of 2025, the gold-silver ratio was above 80 to 1, meaning 1 ounce of gold could buy more than 80 ounces of silver. By the end of the year, that ratio had compressed to about 65 to 1. That is a dramatic shift in a very short period, and history shows that ratio compression is rarely gentle. When silver catches up, it doesn't merely close the gap, it runs ahead, sometimes explosively. Look back at the 1970s. Inflation surged, confidence in fiat collapsed, gold rose, and silver soared far beyond expectations, achieving nearly 700% gains over its previous levels in relative terms. We saw a similar pattern in 2011. Gold was strong, but silver outpaced gold dramatically, moving from $9 to over $50 in just a few months. The principle is the same now. Silver is highly sensitive to panic and fear in a market where confidence in fiat currency is eroding. The current surge is not about speculation. It is about structural forces converging. Consider this. Silver is no longer just a commodity. It is now a strategic asset. Investors are not buying it solely for short-term profits. They are buying it to hedge against the collapse of purchasing power, currency debasement, and systemic risk. That is why the recent 130% gain is only the beginning. The fundamentals supporting silver are extremely robust. Industrial demand continues to grow while supply remains constrained. Investors are entering the market aggressively, recognizing the metal's dual role as money and essential industrial input. And let's talk about supply again, because it is crucial to the story. Silver production globally increased by only about 2% in 2025, reaching roughly 844 million ounces. But here is the problem. Most silver comes as a byproduct of other metals, such as gold, copper, lead, or zinc. This means that even if silver prices rise sharply, miners cannot simply ramp up production. Existing mines are maturing, or grades are falling, and new projects are slow to come online. Environmental restrictions, financing difficulties, and underinvestment in exploration over the past decade have made new supply even harder to bring online. The result is predictable. Deficits continue. Estimates for 2025 suggest that 149 million ounces will be missing from the market, marking the 5th consecutive year of shortfall. Over the past 5 years, global inventories have been drawn down by roughly 820 million ounces. That is real, physical metal leaving the market, not paper contracts or promises. Recycled silver cannot fill the gap because industrial demand consumes metal permanently. These persistent deficits are why silver has developed a price floor that did not exist in prior cycles. The convergence of structural demand, constrained supply, and investor interest creates a scenario where silver can no longer behave like a normal commodity. It is not being priced just for the next quarter or year. It is being repriced for its long-term monetary and industrial role. That is why analysts like Rick Rule argue that we are not looking at a 10% or 20% increase. We are looking at a potential 3 to 4-fold increase as the system reacts to the unraveling of fiat currency and growing awareness of silver scarcity. Another key factor is the psychological element. When confidence in fiat currency collapses, hesitation disappears. Investors and savers do not analyze endlessly. They act decisively. Silver, as physical money, is the first option for many. Stocks, crypto, and other paper assets do not offer the same protection against systemic failure. That is why silver's movements can appear sudden and violent. The market is not just repricing, it is detonating. Investing in silver in today's environment requires more than simply buying metal and hoping for a gain. This is where strategy, timing, and discipline separate successful investors from those who get shaken out. Silver does not reward hesitation, and it punishes the unprepared. Understanding both the physical market and the investment layers is essential. First, consider the role of silver miners. Historically, miners act as a leveraged play on the metal itself. When silver prices rise, well-managed mining companies often outperform the metal by a factor of 2. That is because costs are largely fixed in the short term, while revenue increases sharply as the market price rises. Conversely, miners can decline faster than silver during corrections, which is why allocation and risk management are critical. Investors need to diversify within the mining sector, choosing companies with strong balance sheets, operational efficiency, and growth potential, rather than chasing speculative juniors blindly. Next is allocation strategy. In any precious metals portfolio, physical silver should be complemented with gold and a selection of high-quality mining equities. Gold remains a slower-moving, stable hedge. Silver, by contrast, is volatile and reacts sharply to market stress. That volatility is an opportunity, but it is also a risk if one is unprepared. It is not uncommon for silver to surge hundreds of percent during a bull cycle, only to retreat 30-40% during a short-term correction. Investors must understand that drawdowns are part of the process and should be mentally and financially prepared for them. Timing is another critical factor. Physical silver takes time to acquire, store, and secure. Miners require due diligence to ensure the companies are capable of delivering profits in volatile markets. Both aspects require patience. Silver's current bull market is driven by long-term structural factors, meaning that short-term speculation is often counterproductive. The goal is not to catch the top or buy the bottom, but to participate in the cycle methodically and strategically. One of the most overlooked points is risk preparation. During the 1970s bull market, silver surged dramatically alongside gold, but many investors were emotionally unprepared for volatility. They sold at the first correction, missing out on massive gains. Today, the structural setup is similar but more extreme. Rising industrial demand, constrained supply, and the increasing likelihood of currency debasement create conditions for sharp, unpredictable swings. Being prepared means allocating capital that can withstand temporary volatility, understanding that the bull market will not be linear, and maintaining a long-term perspective. Now, let's discuss the role of macroeconomic conditions. Real interest rates, inflation, and government debt dynamics all favor precious metals. The US dollar's purchasing power is declining faster than official inflation measures suggest. With 10-year Treasury yields around 4.2% and real depreciation closer to 8 to 9%, savers are losing money simply by holding cash. That dynamic forces capital toward tangible assets like gold and silver. Meanwhile, government debt continues to balloon. Official on-balance sheet obligations exceed $38 trillion, with off-balance sheet liabilities pushing the total over $150 trillion. That creates a system where paper currency faces constant pressure, and physical assets become essential. Silver's dual role as both an industrial metal and a monetary hedge gives it unique protection against these pressures. Unlike paper assets, silver cannot default. It is real, tangible, and globally recognized as valuable. When markets experience panic or systemic fear, capital flows decisively into silver, causing rapid price appreciation. Understanding this dual role is fundamental for anyone serious about positioning themselves strategically. Finally, consider the practical side of ownership. Storage, security, and liquidity are critical. Physical silver must be stored safely, either at home in secure vaults or through trusted custodial services. Miners require ongoing monitoring, including operational performance, debt levels, and geopolitical risk exposure. Ignoring these practicalities can turn an excellent investment thesis into a logistical nightmare. We've now covered the structural fundamentals, supply and demand dynamics, historical patterns, and investment strategies for silver. In this final part, it is time to bring everything together into a practical framework that allows investors to navigate this bull market intelligently and safely. First, remember the central premise. Silver is no longer simply a commodity. It is a strategic asset, part monetary hedge, part industrial necessity. This combination is rare and gives silver unique strength. Supply cannot ramp up quickly. Mines produce mostly as a byproduct of other metals. Ore grades are declining, and new projects take years to develop. At the same time, industrial demand, solar panels, electric vehicles, AI, electronics, is accelerating. This creates persistent deficits and a natural price floor that did not exist in previous cycles. Second, understand the psychological dynamics. Markets move faster than most people expect. Confidence in fiat currencies is eroding, and when panic sets in, hesitation disappears. Capital flows decisively into silver, not in small increments, but in bursts. Historical bull markets show that silver amplifies gold movements, often running ahead in periods of panic. Waiting for confirmation or trying to time the top will almost always result in missed opportunities. Investors need to be positioned before the move accelerates, with a clear plan for volatility. Third, consider portfolio structure and risk management. Physical silver should form the foundation of any allocation to precious metals. Gold provides stability and long-term protection, while silver offers growth potential and high beta exposure to systemic risk. Miners provide leverage but require due diligence. Allocation should reflect personal risk tolerance, investment horizon, and objectives. Most importantly, capital must be allocated that you can leave untouched through short-term fluctuations. Drawdowns of 30 to 40% are common even in strong bull markets. Those who panic sell during these swings are leaving enormous gains on the table. Next, recognize the macroeconomic tailwinds. US government debt exceeds $38 trillion on balance sheet, with total liabilities over $150 trillion. Inflation-adjusted returns on cash and bonds are negative. Real interest rates are below the pace of currency depreciation. These conditions are extremely favorable for precious metals. While markets may experience short-term volatility due to policy shifts or interest rate moves, the long-term structural drivers remain intact. The system itself is creating scarcity and demand that paper assets cannot match. From a practical standpoint, investors must secure physical metal properly. Home storage, third-party custodians, and trusted vaults are all valid options. Silver mining equities should be monitored for operational efficiency, debt levels, and geopolitical exposure. Participating in both physical silver and miners allows investors to capture upside while balancing operational risks. It is also critical to remember history. In the 1970s, the US dollar lost over 75% of its purchasing power, and silver outpaced gold dramatically. In 2011, a similar pattern occurred during systemic stress. These are not coincidences. Markets operate according to structural economic forces, not sentiment alone. Today, we are seeing the same alignment of forces: rising industrial demand, constrained supply, eroding fiat confidence, and investor recognition of silver's dual role. For those willing to act decisively, the opportunity is substantial. However, caution is required. Bull markets are never linear. Silver will experience volatility, corrections, and occasional sharp pullbacks. Being mentally and financially prepared is as important as understanding supply-demand fundamentals. History punishes the unprepared and rewards the disciplined. Finally, the key takeaway. Silver is at the intersection of necessity, scarcity, and monetary protection. This bull market is not a short-term anomaly. It is a structural repricing, driven by real-world forces that cannot be reversed overnight. Investors who understand these forces, who allocate strategically, manage risk, and maintain discipline, are positioned to benefit enormously. Those who hesitate, seek confirmation, or underestimate volatility will miss critical opportunities. Financial disclaimer. This content is for informational purposes only and does not constitute financial advice. Always do your own research, DYOR, and consult with a licensed financial advisor before making any investment decisions. Precious metals are subject to market risk, and past performance is not indicative of future results.